State of the Economy show where we are waiting for the CPI numbers for the month of April, and they have come in at 4.7%, which is lower than what the CNBC-TV18 poll said. The CNBC-TV18 poll had 4.79, and there were several on the street with a 4.8 or a 4.9 expectation. 4.7 will be, extremely well received by the street. As it is, the big point is that it is under 5%. We are under 5% for the first time after November of 2021. That was always expected because we have a very high base. Last year, April, the CPI had touched almost 7.8, 7.79% to be precise, because it was the immediate aftermath of the Ukraine war. We had very high edible oil prices. We had high imported coal prices. So all that had pushed the CPI up. And of course, not to speak of crude and crude derivatives. But now, because of the high base, we are seeing a substantial fall in the CPI number to 4.7, first time in 18 months. In fact, I think this is the lowest reading since October of 2021. So it's perhaps the lowest in 19 months. The month-on-month rise in inflation also is very, very limited. So the pace of inflation also has gone down. So it's not just the base effect. It's also that the pace of the momentum of inflation has anyway been coming down. I think the most important part that people will want to know is food inflation. Food inflation has barely moved, about 0.5, if I'm not mistaken, or maybe 0.6 month on month. And the year-on-year food inflation also has fallen to a very benign just 3.84% from 4.79 month ago. And 2 months ago, it was even running at 8 and 9%. So this is a substantial fall that we are seeing in food inflation as well. This is a pleasant set of numbers, you will have to say. And with that, let me, there are more details about the inflation number that I think I should be giving you, but let me see if I'm able to get that. Okay, let me just toss it to our experts who are with us. Nikhil Gupta of Motilal, Oswal Financial Services with us. Indranil, the chief economist at Yes Bank. Lakshmi, Iyer of Kotak Investment Advisors. Aditi, Nayar, chief economist. ICRA is with us. Ladies and gentlemen, okay, it's an equal house. Thank you very much for joining us. I think I should be also giving you the IIP number for March before I toss it to you all, but at the moment I'm having some problem with just navigating this point. 1 minute. We've got only the CPI. I'm not able to get through to the IIP. But okay, IIP has come in at 1.1%. Now that's a bit tragic, that number. Our poll had thrown up 3.8. There were several on the street expecting 5.5. The April-February number is 5.6. So 1.1% industrial growth is a complete shocker. It's not an extremely reliable number, the IIP, but nevertheless, March industrial output comes as a huge shock. There were unseasonal rains, yes, but this is a huge shock. Okay, now we have both the numbers, CPI and IIP. And let me toss it over to the experts. Indranil, first, the 4.7 CPI number, benign or rate hike expectations out of the window?
Our number was 4.64, so 4.7 is broadly in line. Obviously, yes, the bar for the rate hike is quite significantly on the higher side. But let us not forget that we have certain negative news or certain sentimental negative news coming out on the southwest monsoon. And we therefore need to track that very carefully before we sort of announce the final win on inflation and the inflation going forward. Now, having said that, yes, I think, as I said, the bar for rate hikes is quite high. But I personally don't think that globally the interest cycle is over. And that also probably will be a factor that the RBI would have it in its mind as it goes on to decide on the future rate cycle.
Okay. Well, I just have the details now. So before I come to Aditi, Lakshmi and Nikhil, I just want to say that the breakup is as follows. I'll just rattle off the numbers. Cereals prices are up 13.67% year on year, but we shouldn't worry too much about that because the month-on-month inflation is not that high. barely. It's actually come down. Month on month, cereals and products have actually come down. The index is 173.8 compared to 174.4 in March. That was the only cereals number. And I think the other big number that we would watch out for will be milk. Milk and milk products at 8.85% has been the sore point for the last several months, I think almost from January. And there is no sign of that abating. We had Mr. Sondhi on the channel saying that he doesn't expect milk inflation to abate till perhaps October or November. The new season for new calves is what's expected. So that's the sore point. Otherwise, meat and fish down 1.2% year on year. Eggs at only 3% year on year. Oils and fats is minus 12.3 year on year. So clearly edible oils is the one making the difference. Fruit is up just 2% year on year. Vegetables minus 6% year on year, minus 6.5% actually. Pulses is 5.3% only up year on year, not serious. And so on and so forth. So broadly, the food inflation seems to be very much in control, with the overall number for the year on year coming in at a very benign 3.8%. Well, clothing and footwear is high. Clothing up 7.4% and footwear up 7.63%. And again, the services inflation, parts of it is high, but overall miscellaneous is up only 4.9%. That also has a high base. So in miscellaneous, which is largely services, household goods and services is high at 6.46%. Health is high at 6.3%, but transport and communication down to 1.1%. Recreation and amusement 3.83%. Education again high at 5.69%. And personal care and effects very high at 9%. Largely, I would assume, gold prices. Let me quickly tell you the IIP numbers as well. Electricity growth is the one that's really pulled it down, minus 1.6%. Compared to 6.1% year ago. Primary goods is 3.3%. Capital goods has done well at 8.1%. Intermediate goods just 1%. Infrastructure goods again reasonably good at 5.4%. But again, the tragedy comes from consumption. Both durables and non-durables have done terribly. Consumer non-durables minus 3.1%. Consumer durables minus 8.4%. So clearly that is the one that has pulled down the industrial growth number. The February industrial growth has been revised slightly higher to 5.8%, but at the moment it's the very tragic March industrial output number that we have to worry about at 1.1%. Even if this number is revised higher, it can't be a very big revision. So March IIP should have us thinking. It's a worrying number. With that, let me turn it over. Aditi, first thoughts on CPI itself, 4.7%. All worries on inflation at an end?
Thanks, Latha. CPI certainly has come in lower than our expectation of 5%. And the two sub-indices which have come in on the lower side are food and fuel and light. Now, I would agree with Indranil that we still need to remain a little bit watchful. Any concerns on the inflation side from the monsoon are still at us. And temperatures have gone up sharply now, so that is also something that we would need to watch out for. It would be, a very high likelihood of a pause in the June policy at this point in time.
Okay. Thanks for that. There was just a slight loss of audio. Thank you very much for that. I might give you one more number. Core inflation has come in at 5.2%. This is the Informist calculation, not ours. And our poll said 5.1%. So this has come in at 5.2%. That makes it almost in line. Nikhil, your thoughts?
Hi, good evening, Latha.
Yeah.
So, Latha, I think we were also expecting 5%, so it is definitely better than what we were expecting. But the entire surprise is on account of food inflation, because we were expecting food CPI at 5.2%, where it has come. Within food, when you were telling us the numbers, I noticed that vegetables, fruit, oil and fat, almost all except cereals have come slightly lower than what we were expecting, which is what explains this. And yes, this is definitely good news that headline inflation has fallen below 5%, and we need to understand that RBI's expectation is 5.1% for this quarter, for April to June quarter. And at 4.7%, it is very likely that inflation for the quarter will be lower than what the RBI expects.
Okay.
Therefore, we believe that we don't think there is a case for rate hikes. We believe there will be no more rate hikes in India from the RBI.
Okay. Well, there is a fear in some economist circles that inflation will pick up in the subsequent 2 months of the quarter, but we will get to that later. The point is this number has come below expectation, and this is the last number before the MPC meets on June 8th. I don't think there's anything else left by way of data. So they will have to go with this, and there can be very little reason for them to change the pause that got introduced in April. Lakshmi, what does this mean for yields? Do we see sub 7% on the 10-year?
Yeah, hi Latha. So today, ahead of the inflation data, we've already seen the 10-year close below the 7% mark. Intuitively, it looks like ahead of a docile inflation, we've seen some bit of position covering also. But it looks like this momentum, probably can continue for a little bit more. Though I would hasten to add that almost anything and everything positive that you can think of, whether it's on the domestic side or on the global side, including the US yields coming off by almost 8 to 10 basis points, that's already baked into the news. But traders and clearly markets are sitting on the shorter side, and some of them have been caught unawares. So despite the supply, I think the momentum of the winning streak in bond yields can continue for a bit more.
Okay. This 6.9, what would you attribute it to today? Covering ahead of the CPI number?
That's right, the short covering.
Okay. And what do you expect? Is under 7 sustainable?
Well, difficult at 6.5, 0.5% gap is reasonably priced in unless there are going to be multiple triggers. One small trigger is the FPI buying, which is a net positive, no doubt about it. But we cannot completely undermine the week-on-week huge supply calendar, which, cannot meet with commensurate demand. So I would say it's going to be a slow groove from here on. It's going to be a frustrating tight range that you can actually see the 10-year bond yields move in.
Did you see any dip in the call rate? The interbank call rate was ruling well above repo, wasn't it?
That will continue, Latha, because liquidity in the situation in the banking system is still tight, and that is going to continue. That's not going to solve for itself very easily, which is why you see the OIS curve, the swap curve, actually inverted as we speak.
Okay. Well, I'll just come back to you. I just get carried away by bond discussions since that's what investors will want to know. But let me come back to the growth story. Indranil Pan, 1.1. Would you worry on IIP?
Well, our number was, I think, 3.9%, but
that's our average as well.
Yeah. So the thing is that we were factoring in the sort of core number of the electricity into the IIP number. So I think there's some surprise out there because out of the core number, the electricity was definitely a positive number, and you read out a negative number.
Yeah.
So that apart, the worrying part obviously is the consumption bit that you've indicated, and given the high inflation. And little chance of any rate cut by the Reserve Bank of India, and a lagged implication of the past rate increases and the liquidity tightness in the system will possibly have an implication in terms of relatively lower growth trajectory for months to come. Now, let's not also forget that from a growth perspective, I think the Q1 results have to a certain extent surprised on the downside. And that we will need to keep in mind while we calculate all our Q1 growth numbers. So that's where I think growth stands for me. For me, the year's average is still at around 6%, but I'll wait a little bit to sort of see if we can maybe bring it down.
But there is a downside risk, is what you're saying.
Yes, absolutely.
Okay, now that's very important. I'm still tempted by this bond argument. Did you all see the reserves increase today? It's increased for the week ended May 5th by $7.1 billion. That's the kind of money Reserve Bank has bought. I don't think this is a revaluation thing. This is clearly a currency thing. Okay, currencies have gone up by 6.5 billion. That's the kind of liquidity that's going to come into the system. So my sense is that, Lakshmi, your interbank call rate going down towards repo looks more early than perhaps most of us fear. Chances are that another 6 billion will be bought in the current week as well, and we may be staring at a $600+ billion FX reserves next week. So I think liquidity is going to come not through OMO or CRR, but possibly through RBI buying a whole amount of dollars. But sorry, I'll come to that later. Growth story first. Aditi, what's your growth figure, and are you going to have a downside risk now?
So, Latha, we are also at 6% as far as the GDP growth for FY24 is concerned, and we are looking at a downside of up to 50 basis points purely from the impact of the monsoon. So, if we do end up with a moderate El Nino in the second half of the monsoon season, then we would look at a downside of up to 50 basis points coming in from that. I also think part of the low and weak consumption data which is coming through the IIP is because of exports. So that remains an overhang that we will have to keep tracking. Last few months, it's been services exports which have really held up. And I suspect that the Q4 current account deficit number is going to be really quite benign because of services surpluses being on the higher side. But the impact of merchandise exports, that is something that will continue to worry the growth picture going ahead, and will lead to some worries on the current account deficit as well, although we expect it to be, really not a concern overall, but still FY24 current account deficit could be higher than FY23. On the bond yields, since, we were talking about it, I would like to offer one thought as well. April and early May, especially April, we saw that the state government supply was really on the lower side, which we understand is because some states may not have had the permission to borrow as yet at that point in time. And we do think that there will be some catch up in May and June. So supply may not be as high as what was there in the indicative calendar, but it may certainly pick up compared to what we saw in April.
Okay. Well, actually, there are so many imponderables going ahead. There are some people who are guessing that small savings are going to be very good given the rate hikes. So government perhaps may even cancel some auctions late into the year. But all this is like guessing too ahead of the curve. We have to worry about the crude price next week and what government does about the excise duties as well. So let's not get into that. At the moment, it does look like with liquidity improving because of the government's, the RBI's dollar buy, and because of perhaps HDFC Bank buying, or because of insurance companies buying, we are seeing a very benign yield curve, or almost a flat yield curve. We have overnight at 6.6% and 10-year at 6.99%. I mean, I can't remember when we last saw such a flat curve. Back to the growth discussion. Nikhil Gupta, I know you are among the most pessimistic in terms of growth expectations. I think 5.5 is what you're sitting at. You feel vindicated, or do you think it can be worse than 5.5?
No, Latha, we are actually officially at 5.2%. But yes, the official number for FY24 is 5.2%. And this March number of 1.1% was certainly surprising. We were also close to 3.7, 3.8 for the And irrespective of the weaknesses that we have in IIP, it is important to understand that IIP is an important input when the quarterly GDP forecast or GDP estimates are done. So yes, this worse than expected March number may have some downside for Q4 23 numbers. But in any case, I think FY23, 7% is the most likely number. For FY24, we are at 5.2%. We may revise these numbers slightly upwards. I don't think there is any more downside vis-a-vis 5.2%.
Yeah. No, not at your level. Yeah.
But yeah.
At 5.2, I guess there is a downside risk, which is almost looking impossible to me. And by the way, we could have this debate later, Aditi, but I wouldn't be surprised if we are almost in current account surplus for the quarter just gone by. And for the year ahead as well, I think we're more likely to be lower than FY23, the way crude is trended and the way other import prices also have trended. Coal prices and other things. So perhaps we could be in for a pleasant surprise on the current account front. But be that as it may, Lakshmi, the question comes back to you. 6.99 liquidity flowing if you looked at the FX reserves and terrible growth numbers. So will all this sentimentally push yields lower?
So as I said, Latha, bulk of the positives, whether it's on the globe, the US Treasury yields touching 3.42 or expectation of an inflation number at sub 5% is incrementally baked into the prices. So it will require a Herculean task for the 10-year to durably sustain below the 7% region. Risk reward, if you ask me, still favors being closer to the mid end of the bucket, a 3 to 4 year duration bucket, because 1 year treasury bill is offering you 7%. The curve is almost flat. So risk reward incrementally does not really favor significant extension of duration. But as I said, the psychological, sentimental comfort will allow the halo of bond yields to remain a little bit lower for longer.
Okay. Almost a slight inversion, isn't it? I mean, perhaps this is not classical bond inversion because there are some liquidity considerations, but we are actually in a slight bond inverted, although we are speaking about 6% GDP growth. But yes, in certain parts of the curve, there is an inversion. We can't take the eye away from it. 1 year is close to 7, is it? I thought it was more like 6.8 thereabouts. But even then, it's a flat curve. Indranil Pan, last word from you. What are you expecting by way of bond yields? Do you think that we are going to get, a sub 7% bond yield for long?
So I think Lakshmi did talk about the market perspectives and Aditi did talk about the fundamental perspectives. My own sense is that in terms of net supplies definitely go up in some of the months, even in the H1 period. The second thing that we need to watch out for is, of course, the inflation and how the global yields are moving, because Indian yields continue to follow global yields. My own sense is that we might not see a sub 7% for very long, and we might actually come back and settle at around somewhere around the 7.15 to 7.20 mark. Simply once again because the differential in terms of the 10-year yield and the overnight rate is not something that is justified on the premise of a 6% growth that we are talking about.
Well, I just have a couple of minutes and let me see if I can pass this question to many of you. But let me start with you, Aditi. This dipping of the yields, will it help growth or is it an indication that growth is going to be weak?
No, I think I feel that it's more to do with market factors and liquidity, like you're saying. I think I've agreed with almost everything Indranil has said today. I also think that yields will go up a little bit over the next couple of months.
Fair enough. Yeah, there is unusual insurance buying because of the pre-March 31st tax-related purchases of policies, perhaps. But take a shy at it. Nikhil, you think bond yields are dipping, flagging off slowing growth, which IIP is telling us, or is it going to help growth because now corporates will borrow cheap?
That's how you seriously do get carried away with bond yields discussion.
Okay.
So as far as my views are concerned, I don't think I agree with the rest of the panelists. I don't see it sustaining at 7%. But the only thing I want to say is that there is a tug of war, and on the one side we have slow growth concerns, which are definitely going to bring down yields, and on the other hand, we have, as Lakshmi mentioned, most of the positives have already been baked into the bond yields that we have currently. Okay. So it's going to be probably what Lakshmi concluded, that it's going to be frustratingly in a very narrow range for some time to come. And some event needs to happen for bond yields either to go down or to go up on a sustainable basis. Okay. But yes, 7% is somewhere where we don't see at this point that it could be 6.5 or 7.5.
Okay. Yeah, no, I know I get carried away. I'm sorry. I apologize for that. But, it is one of the reasons why people were marking down growth, right? Because RBI has pushed up rates. And if yields are going to already start pricing in cheaper cost of capital for corporates, maybe it balances the growth worries. All if you are having a downside risk to growth, maybe it balances out. I'm just trying to look at the brighter side and see whether that brings in some growth. But thank you very much, ladies and gentlemen, for joining me in this extremely interesting conversation. We normally concentrate more on CPI because that's the policy-making number. But today, the headline is the IIP. The shocking 1.1%. It comes on a 3.6% core sector growth, which we already have got for March. So we better start worrying about growth. On that note, we wrap up on this special broadcast on the state of the economy. Do stay tuned in. More news and updates follow.